Welcome back. Again, you can go to our Facebook page. Kathy Bannock from Authentic Homes is going to hook you up with free passes to the remodeling show. So just go ahead and, I don't know, write a note to us and Heather will figure it out, I'm sure. Yvonne Hall joins us, Senior Vice President and an Investment Officer with the Hall Wealth Management Group of Wells Fargo. And Yvonne, we talk about buying houses and we talk about decorating houses, but all this costs money.
Yes, it does.
Yeah.
It's kind of nice to figure out how you're going to afford those things before you buy them.
Yeah. And so you had talked a little bit before when we were prepping, and you talked about this equation for success, which is something that you work with a lot of clients on.
We've sort of identified, my business partner and I are both certified financial planners. And what we've observed in the past 18 years of working with people is that there's a simplistic formula that says there's two variables that determine how successful an investor is going to be. One is what they own, and we spend a lot of time working with them on their portfolios, and it is important. But we find that variable is dwarfed by the magnitude of how the investor behaves. And so we spend a lot of our time on the coaching and education to help the investor's behavior support the portfolio that they own.
And so, this really kind of it's a great plan, poorly executed, doesn't do a whole lot, I think is kind of.
And the absence of a plan is probably as bad or worse than no plan at all.
So what are some examples of this bad behavior? Help us understand a little bit, because I know the bad behaviors that I'm thinking are probably different.
You know what? They actually transcend. If you look in real estate and you look in different parts of the economy, the more someone knows themselves, the more effective they are at accomplishing what they set out to do. Bad behaviors are the failure to plan, the failure to be realistic, getting swayed emotionally by what's happening in the market, living beyond their means, not saving enough, and spending too much.
You talk about the failure, but maybe one of the big ones in failure to plan is actually doing a really good job of buying crap you don't need.
Knowing what your priorities are.
I meant stuff you don't
need.
Yeah. How do people then, when you have this goal in mind, how do you coach them to maintain these really great behaviors?
The goal is the client's goal. And that's the most important thing. I actually read an interesting book about willpower recently, and it talked about three components of what people will do for what they want, what they won't do in order to get what they want, and then the important part is what do they want, because that's the motivator, that's the why that we do anything. And so as we work through a planning process with our clients, we help them define the different goals that they have, and then very importantly, prioritize those goals. Most of us may be able to do many of the things that we want to do, but not necessarily all of them. And with that clear vision of what you're trying to accomplish, it makes it easier to apply the right behaviors.
And so that's something that, I guess in the very beginning, in talking with somebody, helping them determine those goals must be a big part of that.
It's the most important part. There's, people find that you work in investments, and the question's always, what's a good stock or what's a good fund?
What's the market going to do?
Right. And who knows? I don't even pretend to know that. Our work with clients is it really depends, what are you trying to accomplish? And then we can help you craft a portfolio and an action plan that will help you be successful doing that.
And then once you craft this, you end up, I guess, having to kind of develop different behaviors, right? I've heard the only way to get rid of bad habits is to replace them with new ones. And that's got to be a big part of that, especially coming from somebody who has no plan and now going into maybe a strategic plan that takes discipline. You must have to deal with that a lot.
It is one of the most enjoyable parts of our review process is really to come back to clients about, are they on track for what they're trying to do? If not, what's changed, what needs to be adjusted, and helping them. Life changes. The goals that you set at 25 may look very different at 35. It's the opportunity to monitor those on an ongoing basis and make course corrections and adjustments that reflect, as Kathy talked about, your authentic self, your real self, the goals that you have today. And that's what a good plan should do.
So throughout your life, you certainly have these different relationships with money. You said your goals changed from 25 to 35. When I was 25, I was just trying to figure out how to get to Vegas again. And now that I'm almost 35, certainly that's not what I'm trying to do. How do you guide somebody to have these different relationships throughout their life?
People have to want to be coachable in order to be coached. You can't motivate someone if they're not motivated for their own interests, but most people are. I think a lot of us go around with a vague sense of guilt. People think I should be doing something more about my retirement. I should be doing something more about my children's education. Maybe I'm doing enough. There's sort of a denial, and with that denial comes a lot of worry and anxiety. So clearly facing the reality of, here's what I've got to work with. Here's what I'm trying to accomplish. Here's, Harvard may not be realistic. Okay, community college may be,
might not be realistic because of grades.
Right. There's many reasons it might not, but looking at the reality of what is typically very liberating for people because it puts them back in control. The market isn't driving what they do. They actually have choices to make, and that puts them back in the driver's seat for their plan.
We're here with Yvonne Hall, Senior Vice President and Investment Officer with the Hall Wealth Management Group of Wells Fargo Advisors. And Yvonne, we have about a minute left before we have to go to break. But, you talk about 25, 35, 45, these goals changing throughout life. How has your business changed, I guess, over a 10-year period, like say over the last 20 years, or how do you see people's goals changing?
It's been a very interesting 10 years to be an investor and 10 years before that. So what we've observed is people judge the future by the most recent past. So when we were providing advice to people in the late 90s, a lot of our work was coaching them to have more tempered expectations. Everybody was going to retire at 45. They were going to have, a beach home in Hawaii, and they wanted to use unrealistically high rates of return. Now that we've been through such an extremely challenging decade, and particularly after 2008, there's a tendency to think, well, why bother? Real estate's never going to recover. The market's always going to be a struggle. Do I need to invest at all? And for most people, it's not realistic not to, because the pensions aren't there, Social Security isn't going to be enough. So it's important to temper those expectations in both directions.
And so, you really have these two huge swings versus overly pessimistic versus, years ago, extreme optimism.
Absolutely. And so the focus is to try to use some objective planning tools, some modeling tools to help people get a realistic center of what probable outcomes are so that they can be better prepared for a wide range of scenarios.
Well, Yvonne, we have to go to break. Again, that's Yvonne Hall. Thanks so much for joining us. And I love this phrase, this judge the future by the most recent past. And we're going to continue this conversation, bring everybody back, because I think we're going to discuss a little about clients being realistic and maybe not judging their future just by the most recent past, but about what's really going on. My name is Ben Brash, and that was Yvonne Hall. You're listening to Brashonomics.